Thank you, Shobji. Hello, everyone. Good morning. I hope everybody has joined in. Maybe I can wait for a minute and then I should start. Good morning, Saminathan. Good morning, Sanjay. Okay, so let's start for today's remaining session uh, for India's 37. So in the previous session, what we have talked about is we try to understand, the three items which are dealt by with this India's. The items were number one, the provisions, right? Number two, the contingent liabilities, and number three, the contingent assets, right? And we have done a few, examples and questions to crystallize the understanding around those three items, right? Now, today we will be talking about how we are going to measure at what value the provision will be measured. So now, by the time it is established that for something a provision needs to be recorded because there is a past event, right? So we have spoke about past event in detail in the previous session, right? Hope you are able to recall whatever the discussion we have done in the previous session. So past, because of past event, there is a present obligation which gets triggered, right? So the conditions were there is a past event, there is a present obligation arising out of the past event, and then a reliable estimate can be made and probable outflow of economic benefits, right? So the condition number one, past event and the present obligation is satisfied. Number two, the probable outflow will happen in the future is expected. So this is also satisfied. And the third condition, which we were talking about, reliable estimate can be made. And I said at that time that it is generally, deemed met condition because it is very difficult for some organization to come and say that they are not able to measure something, right? So there are certain difficulties in arriving at a particular value for a particular provision, but generally it is not impossible, right? So in that case, the third condition, which was expected to be deemed met, so all the three conditions met, provision needs to be recognized in our books, right? Now, how that measurement will happen, right? So the condition was reliable estimate can be made. Okay, understood. That is satisfied. But how we are going to measure that provision now? So that's the topic for today, right? So we will do some practicals as well. So let me quickly reach, right? So now we will talk about the measurement. So standard says that first of all, there should be a best estimate, right? So best estimate means whatever the management, can estimate towards to best of its abilities using whatever the data information is available around that matter, right? So suppose there is a case in the court of law, right? And now we need to measure at what value we should recognize the provision in our books of accounts, provided the other conditions are met, right? So assuming now for today, the all discussion will revolve around the estimate measurement rather than talking about whether the provision will be recorded or not, right? So that discussion we have done in the previous session. Now today, assuming that past event has occurred and present obligation is there, now we need to see how we are going to measure at what value we are going to record the provision, right? So that's the focus point for today. Now, standard says best estimate. What do you mean by best estimate? Any guesses? What do you think? What is the best estimate? Anybody, please? Okay. So best estimate is whatever, best possible estimate can be arrived using whatever the information or data points, the or the assumptions management can apply, right? So in this case, what will happen? So do we need to plug a random number? Say, okay, let's put a provision of rupees 50 lakh for this particular case, pending in the court of law against us by our supplier or the customer, right? No, we are not going to do that, right? So what we are going to do, we will seek a opinion from our lawyer, right? What do you think? What would be the expected cost the company will incur if the company loses this case, right? Then lawyer will say that generally in this case this would be the damage payable to the party. Number one, this would be the legal cost the party has incurred, that is also reimbursable. Number three, this is the fees which I will be taking, or these are some other operational expenses, right? So maybe some estimate we can make, uh, assuming what all outflows are probable, right? So considering all the probable outflows, whatever the best information is available, we will try to estimate something and we will record that, right? So that would be the best estimate in this case. Then there are certain risk and uncertainties. The standard talks about, possibly it is quite possible that we assumed that the other party would be demanding a damage of rupees say 1 crore, right? But later on, the actual outcome comes that they are asking for 1.5 crore, right? So there are always a uncertainty and risk involved in the best estimate or in whatever the estimate the management is doing today. So to factor in to those risks and uncertainties, we need to keep a check on our estimate value, right? Or on each reporting date, right? So at each reporting date, if there is a further development or any additional information has come into our knowledge, then we should use and revise our best estimate, right? So risk and uncertainties needs to be factored in. Then under IGAP, I hope you are able to remember that we have never used the present value factor, right? So in case any provision which is not expected to be settled within next 12 months from the reporting date. So for example, if I am preparing the balance sheet for 31st March 2025 and the chances are less that I will be settling a particular liability against which I have recorded a provision in next 12 months, then it would be a kind of long term provision, right? So it's not a short term. So for that, under IGAP, we have never used the discounting. Is that correct? Or anybody used? Yes,
Yes,
no,
yes, correct. Never used, yes.
never used, right? So that's the key difference between IGAP and NDS, right? So under NDS, if the provisions, are falling outside of the 12 months from the reporting date, then we would be using the discounting as well, discounting factor. So we will arrive at the present value of the provision liability and we will record that amount as a liability only, right? And year on year, we will do the unwinding, right? So we will do the numerical. It will be, clear, right? And then there are certain chances, we need to revise our estimate, right? Basis on some future developments, right? So future, what will happen in future, we cannot record today, right? But whatever the possibilities are there, we need to factor in. So we will do some practicals around this to understand how we are going to do, under what situations we need to adjust something. So all we will discuss. And then expected disposal of assets. So suppose if there is any restructuring going on in the company, right? And in the previous session, I spoke about that if there are restructuring, then we are not going to record any provision unless and until the action on the ground is started, correct? So there are three phases to the restructuring. Number one, restructuring is in the head of the management. So management is just thinking about to do some restructuring. Are we supposed to pass an entry in the books of accounts as an accountant? No, right? Management is doing the discussions, they are conducting the board meetings, they are having the discussions, but nothing concrete has yet been started. So no accounting entry is triggered for recording any sort of the provisions. Number one. Number two, management has announced the plan, right, that they are going to do the restructuring, right, in next 2 months, 3 months, or in next 30 days, whatever, right? Are we supposed to do pass any entry for any provision in the books of accounts at this stage? No, because mere announcement doesn't mean the restructuring provision needs to be recorded, right? Announcement doesn't trigger any recording of any provisions, right? Now, the third situation, management, whether announced or not, but has started implementing the steps planned to conduct the restructuring. For example, they have identified the employees who will be laid off. They have started doing the negotiations with the vendors and the suppliers, right? They have started discussions with their customers that we are going to do some restructuring, and because of this our location will be changed or something like that, so our delivery schedule or logistics will arrangements will be updated. So we will in the future we'll start doing the business from a different location. So all those discussions have started with those person who are affected by the restructuring, right? So if this is the stage, then only we are supposed to do uh, you know uh, accounting entry for the provisions related to the restructuring, right? Now, within that restructuring plan, if there are certain property, plant and equipment, right, any plant and machinery or any furniture or any other ppnd or fixed assets which are there in the factory or office, right, which is not expected to be used after the restructuring is completed, so management plans to dispose all those assets, right? So whatever the amount will be realized by disposal of those assets will be netted off with the restructuring provision or not. That's the question. Are you able to understand my question? That restructuring plan has been commenced on ground, right? So provision for restructuring is required to be recorded because there is a past event. Past event is restructuring plan started. Present obligation, yes, because management has proceeded with the restructuring plan. So certainly there would be certain additional costs the company would be incurring in order to carry out this restructuring. So those additional costs needs to be provided for in the nature of a provision in my balance sheet on today's date, right? How much the actual expense will be incurred, that will certainly be trued up in the future, right, as and when they are incurred. So I will reverse the provision, I will book the actual expense later on, but that's a separate exercise. But today I am recording a provision. Now this provision should be recorded at the gross amount of the restructuring cost or should be netted off by the expected realizable value of those plant and machinery, furniture and fixtures which will not be used after the restructuring is completed, and hence management is planning to dispose them of. What do you think? So Samanathan is saying net off. Okay. Others, just try to think logically and come up with your answer. Leela is also saying net off. Okay. Others. Okay. So standard says this shouldn't be net off. Okay. No netting off. The provision will be recorded separately and the disposal will be accounted for as per the accounting requirements of which standard? Ind AS
105.
16. So Ind AS 16 only talks about the disposal of property, plant, and equipment. So 105 is non-current assets held for sale and discontinued operation, right? So that means where we are planning to, you know, uh, doing any demerger, to do any demerger. So restructuring is different. Demerger or sale of subsidiary or sale of a business unit is a different thing, right? So 105 is not applicable in this case unless and until this restructuring also has some sale of operations. So we are not selling operations. We are doing some restructuring only, reorganization within the company, not planning to sell any business unit or any business line or any product line per se. If that is also the case within the restructuring plan, then 105 will also get triggered, and fair value less cost to sell would be the measurement basis on 105, right? Is that clear?
Yes, clear.
Right. So in this case, India 16 will take care of any disposal of assets. So what India 16 says around disposal of assets? So India 16 says, as and when the management disposes any of the assets, whatever is the gain or loss realized on those assets will be recorded in OCI, right? Or PNL. What do you think? PNL or OCI? PNL, correct? So India 16, because there is a specific standard to deal with the purchase of fixed assets, the amortization or depreciation of fixed assets, and the disposal of fixed assets. So this standard is not going to interfere in that matter, right? So standard is explicitly talking about that for recording any of the provisions related to the restructuring, expected disposal of assets will be ignored, right? That is not in my scope. So that will be dealt by the respective standard, that is India 16. Is that clear?
Yes.
Perfect. Okay. Now, under the best estimate rule, a standard further, trying to help us by giving two techniques to measure the value of the provision, right? Technique number one is expected value method. Technique number two is most likely outcome method, right? So there are two methods or techniques, whatever you want to call it, are given by the standard, right? But it is not the case that we only need to apply either of these two, right? If there is any other basis which we want to use, right, to come up with a value for a particular provision, that can be done, provided that gives the best estimate, right? Now, standard says best estimate refers to the amount that an entity would rationally pay to settle the obligation at the end of the reporting period, right? So, from this definition, we are able to identify crucial conditions, right? Number one, best estimate is the amount that the entity would rationally pay, right? Rationally means prudently, right? So, whatever the a prudent person would be, agreeing to pay for a particular liability, right? Or what is the rational amount that would be required to be paid to the other party to settle the liability or the obligation, right? Number one. Number two, when we are going to measure this value at the end of the reporting period, that is the balance sheet date, correct? Yes or no? Right? So we are assuming on the balance sheet date whatever would be the amount, the entity would be liable to pay to the third party to settle the obligation, right? So that's the definition given by the standard for the best estimate. The amount provided should be the best estimate at the end of the reporting period of the expenditure required to settle the obligation, right? So that's what we have understood from the definition as well, correct? Now, two methods, expected value method and most likely method. So let's do the numerical first to understand these two methods, right? Company A sells a product with 1 year warranty. 2001 number of items sold are 5 lakh. Cost to repair one item is minor defects, rupees 20 per item, major defect, rupees 60 per item, right? In the past, when management has digged into the past data, so they noted that in last 5 years data, whatever the products they have sold, taken together, 75% of the goods were okay. No defects were reported by the customers. In 20% of the goods cases, minor defects were reported by the customers. And in 5% of the cases, only major defects were reported. What provision should you be recorded in the books of accounts for these warranty costs for the current year? Would you like to try?
Yeah, minor defects would be 20 lakh rupees.
Mhm. So you need to tell me the amount of the provision. At what value you will pass the entry for the provision for the current year. So Samanathan is saying 20 lakh on minor, 15 lakh on major.
35 lakhs is the total cost.
So total 35 lakh. Okay. So how did you arrive at this amount? So what you did, number of units sold 5 lakh, right? Into my 75% is the probability and 0 is the cost of repair, right? So 0. Then 5 lakh into my 20% of the goods found minor defects, 20 rupees is the cost, right? So 20 lakh. And then 5 lakh into my 5%, is the chances of major defect, and 60 rupees is the cost of each defect correction, correct? So 15 lakhs. So total amount is 35 lakhs, which you have arrived at. This amount would be treated as a provision for warranty cost, right? And this will be recorded in the P&L, correct? And will be appearing in my current liabilities under the provisions, right? In the balance sheet. Now, when you did this calculation, what exactly you did subconsciously? So you have applied the probability weights, right, to the total quantity sold and the amount for each of the defect correction, right? So this is called the expected value method. So you have arrived at expected value, or expected outcome value, maybe. So whatever is the expected outcome, then that expected outcome is assigned a value, right? So that is called expected value. Now, why this is called as expected? Because this is not actual results may turn out be different, right? Because we have just did some data mining for last 5 years, 10 years, and we have came up with these probability weights, right? But it is not a sure shot guarantee that in case any minor or major defects comes, then it will be falling as 20% and 5% only. They may be 25% and 2%, something like that. And any percentage can come in the actual results. So that's why it is expected. Is that clear? So expected value method is used to measure the provision where large population of the items are involved. The obligation is estimated by weighing all possible outcomes by their associated probabilities, right? So that's what we have done. So expected value method is generally applied where outcome is more than two, right? Three outcomes, four outcomes, five outcomes, six outcomes, right? So we will assign the probability for each of the outcome and then we will arrive at the expected value. So in this case, what was happening? How many outcomes were there? Number one, no defect. Number two, minor defect. Number three, major defect. So there are three possible outcomes. Hence, expected value method gets triggered, right? Now, let's do this question. An entity faces a single legal claim with a 40% chance of success and 60% chance of failure with a cost of INR 1 million, right? Expected value is not a valid method in this case. Why? Because the outcomes, number of outcomes in this situation are only two. So if there are only two possible outcomes, right? Good or bad, right? Win or lose, right? Head or tail, right? So in this case, expected value technique will not be applied. In this case, which method will be applied? Most likely outcome. So which outcome has the better probability, right? So that method, that outcome will be measured, right? Now, which out so what is the outcome? Outcome is win or lose, right? Wins probability is 40% and loss probability is 60%, right? And cost is how much? 1 million, 10 lakhs, right? Now what do you think? What is the value of the provision in this case? 10 lakhs only, because in this case we are not going to apply the probability weights in order to arrive at the value, because there are only possible two outcomes. Either if I win, I will incur zero cost because I have won the case, and if I lose, I will incur the whole amount of 1 million because I have lost. So if chances of loss are 60%, it means the whole amount of 10 lakh will be payable to the third party, and hence the provision estimate is 10 lakh. Is that clear?
Clear.
Right. Now, tell me, do we have a free choice whether we want to apply the expected value method or the most likely outcome method, or uh, we need to apply the expected value method mandatorily if the outcome is more than two, and if the outcome is two, then most likely method will be applied mandatorily. What do you think?
Yes, if it is more than two, then expected value method can be used.
Can be used or will be used?
Will be used.
Will be used, right? So there is no free choice available. So if the outcome is more than two, we have to apply the expected value method. We need to find the relevant probability weights, right, for each of the possible outcome basis on either the past data, and if the data is not available, basis on the best management judgment, right? Is that clear? And if the outcome is only two, either I will win the case or I will lose the case, then expected value method cannot be applied, can never be applied, and most likely method will only be applied, right? In those situations. So the number of possible outcomes will decide which method will be applied, right? Okay. Where the effect of the time value of money is material. Now, we will talk about the new item which we have never seen in the IGAP, right? So IGAP never talked about or required us to do the present value of any of the provisions, right? So whatever the provisions we were calculating, we were simply recording them at whatever the value we have calculated or measured, right? But Ind AS 37 specifically says if the time value of money is material, then the amount of the provision should be, or rather shall be, right? Shall be. So it means it is also a mandatory thing. Correct? So are we going to read Ind AS like we used to read income tax or the Companies Act? Yes. So even if Ind AS is also using the word shall, it means it is mandatory, right? So Ind AS Bare Act, if you ever get some time, just try to read the Bare Act as well in conjunction with your material, so that you will be able to understand how the Bare Act is written, right? So provisions value will shall be the present value of the expenditure expected to be required to settle the obligation, right? The discount rate shall be a pre-tax rate, right? So again, the word is shall. Shall means mandatory. Can you use the post-tax rate? No. Standard specifically says the discount rate shall be the pre-tax rate, right? It cannot be post-tax rate, right? That reflects the current market assessment of the time value of money and the risk specific to the liability. Now, when we determine the discount rate, what factors the standard is expecting us to keep in mind? Number one, what is the current market assessment, current market scenario, current market situation, right, of the time value of money? So, what is the general time value of money is there in the economy, right? So what would be that? Government bond interest rate, corporate bond interest rate, RBI interest rate, SBI interest rate, which interest rate? Or interest rate on the FD? What do you think? How the time value of money will be understood in this situation? So Samanathan is saying government bond interest rate. Okay. So are you able to recall the CAPM model?
Yes.
What was that?
RF plus beta into RM minus RF.
RF plus
Beta into RM minus RF.
RF plus beta into में
RM minus RF.
RM minus RF.
Yes, beta into RM minus RF.
No. Something is wrong.
RF is separate. First RF is separate. Then plus beta into RM minus RF.
This is what you are saying.
This, but first two brackets has to be removed. RF plus beta removed.
Okay.
And beta and RM minus RF.
Okay. So you are saying RM minus RF, market rate of return minus
Yes.
fixed rate of return on the government bond, right? Into beta plus RF. That's what you are saying, right?
Yes.
Okay. So in this case, what you are trying to do? So standard is not talking about that we need to use the CAPM model or we need to apply the CAPM model. I'm just trying to correlate what we know already and what we are going to do now. So the standard says the discount rate should be the pre-tax, right? So one rule is clear that post-tax rate we will not use, we will use the pre-tax rate. Number one. Number two, the standard says the current market assessment of the time value of money. So whatever is the current, time value of money is prevailing in the economy, that needs to be considered for using the discount, using as a discount rate, right? That's the another condition. So condition number one, pre-tax rate. Condition number two, the current market value, current assessment of the current market assessment of the time value of money, right? And condition number three, risk is specific to the liability, right? So these are the three items which the which are the factors which we need to keep in our mind while coming up with the discount rate, right? Then standard says the discount rate should not reflect the risk for which future cash flows estimates have already been adjusted, right? So four conditions. Number one, the pre-tax discount rate. Number two, time value of money should be the decided basis on the current market situation. Number three, risk specific to the liability. And number four, if there are any chances of deviation in the future cash outflows pertaining to this liability, then those factors shouldn't be adjusted in the discount rate, right? So let's do this question so that we will understand. We'll come back on the literature. An entity has a provision for which the expected value of the cash outflow in 3 years time is 150. So after 3 years, 150 rupees will be expected to be paid by the company to discharge this liability for which the provision is required to be made today, right? So 150 is the cash outflow expected at the end of the 3 years. Risk-free rate of interest in the economy is 5% at present, right? Which is generally considered as which rate in India? Government bond, right? Interest rate, yes or no? Right? However, there is an uncertainty regarding the outcome and the entity would settle instead of a certain payment of INR 160 in 3 years time. So कह रहे हैं कि 150 is the estimate है कि maybe something less, something more would eventually be payable as and when we reach to the date when it is payable, right? But as of now, the best estimate is 150 at the end of the 3 years. 5% is the government bond interest rate, that is the risk-free rate in the economy. But if you want to bring in certainty, then 160 is what the amount which eventually will be payable at the end of the 3 years, and 160 is fixed. There is no uncertainty that the amount will be changed. Calculate the present value of the provision. Now, two situations. If cash flows are adjusted for the risk, then the discount rate will be risk-free because cash flows are adjusted, right? And if discount rate is adjusted for the risk, then discount at risk adjusted rate we need to calculate. So let's first calculate cash flows are adjusted. So cash flows are adjusted means 160 is the adjusted amount of the cash outflow. How many of you agree that 160 is the risk adjusted cash outflow? Yes or no? Yes, because facts of the question says that there is an uncertainty regarding the outcome and the entity would settle instead for a certain payment of INR 160, certain payment. So 160 is the certain payment. So 160 is the risk adjusted cash outflow expected, right? So 160 will be discounted at which rate? Risk-free rate, because risk is already being adjusted in the cash outflow. Yes or no?
Yes.
So what will that rate be? 5% given in the question. So what would be the present value? INR 138, right? For 3 years, you can use the calculator. You will come up with this value. 138 would be the 3 years discounted value of 160. Is that correct? At 5%?
Yes, it comes to 138 point
Correct.
something.
So this is the standards requirement. Now, if we say no, we are not going to adjust the risk in the cash outflow, then certainly we might need to adjust the rate, interest rate in that case. So in that case, what will happen? Present value assuming will remain same 138, right? Then 150 will be discounted at some rate which will be considered as the adjusted. So if we come up with the rate calculation by using the present value at 138 and future value at 150, are we able to calculate the rate? 2.8%. So if there are always three variables, right? Present value, present value, time, and the rate. So time we know 3 years, present value we know 138, future value we know 150. So rate can be calculated, right? So we can calculate the rate. So this would be the rate risk adjusted in this case, right? So 5% is the risk free rate and risk adjusted rate is 2.8% coming up in this case. Now the thought or the query or the doubt may arise, how come the risk adjusted rate is lower as compared to the risk free rate, right? Is that the query somebody has? Yes, no?
Yes. Yes.
So in this case, what is happening? Because risks, when we do the adjustment of the risk, it is increasing my amount, right, of the probable outflow. And considering that amount, right, at the risk free rate, I had arrived at present value of 138, right? Now, in this case, I have assumed that 138 remains the same as the present value. Then at what rate 150 should be, discounted? And that rate I am computing, right? So generally, when we calculate the risk adjusted rate using the CAPM model, so it is always like risk free rate plus risk premium, right? Which is the beta into my RM minus RF, right? Correct?
Yes.
So market rate of return minus fixed rate of return into my beta and plus RF is equal to the risk adjusted rate. But in this case, what is happening? My risk adjusted rate is coming down as compared to the uh, risk free return, right? So that is because of beta. If beta is greater than 1, it will increase. If beta is lower than 1, it will decrease, right? And market rate of return and fixed rate of return also sometimes vary, right, in the economy. So it can happen, but chances are very rare, right? So I will not say it cannot happen, but chances are very rare. Generally, always risk adjusted rate are higher as compared to the risk free rate, right? So let's do one more question. Beta has an obligation to restore the seabed. Seabed, when the companies uh, extracts the oil from the sea, so they insert the oil rigs in the seabed, right? So the obligation is to restore this seabed after the oil extraction life is completed for the damage it has caused in the past. It has 1 million cash to pay as on 31st March 2025 relating to this liability. Beta's management consider that 15% is the appropriate discount rate. The time value of money is considered to be material. Required. Calculate the amount to be provided as on 31st March 2023 for the cost of restoring the seabed, right? So, company is preparing the balance sheet for March 23 and on March 25, the amount is expected to be paid. So, it's a 2 years time, right? Which is more than 1 year. And hence, the cost of time value of money is material, which is also given in the question. Now, how we will calculate this? So we will simply discount the 1 million payable after 2 years divided by 1.15 is to the power 2, right? So we will come up with the amount of 756. Yes or no?
Yes. 756, 143,
Okay.
145.
What will be the journal entry? on 31st March 2023 in the books of accounts now? What is the journal entry? Any luck?
Obligation.
Mm-hmm.
We'll make provision for 7,56,144. Yeah, restoration
Restoration
obligation at
obligation
debit
756 144 to
provision.
provision. This is the entry. India 36. Oh, sorry, India 16. Please try to recall what India 16 says. What India 16 says? So India 16 says whenever the oil rig was getting capitalized
We
at the very
we
time
yeah, we add it to the PPE and
we had to the
oh,
PP&E, right?
yes,
So
yes.
so assuming the same thing, what would be the entry? So entry would be PP&E
Yeah.
debit.
The
Yes or
provision
no?
for restoration
To
obligation.
provision for restoration obligation. Correct? What is the amount?
Yes,
756 144. 756 144. Correct? Yes or no?
yes, correct.
Now, somebody might be doubting, is it the life of the oil rig is 2 years only? That because this entry is generally passed at the time of the capitalization of the asset, which is being restored or which is being dismantled at the end of the life. So does India 16 only allows to capitalize these costs at the time of the original asset capitalization, or it can be capitalized at some future date also?
At the time of the original asset acquisition.
Only?
Yes.
No. So India 16 says, two things. Number one, at the time of capitalization of original asset, right? Original asset in this case would be oil rig, for example. Yes or no? Oil rig, right? So at the time of the installation of the oil rig will be capitalized, right? And because we have to remove this oil rig and restore the seabed, so that additional expenditure which we will expect to incur at the end of the oil rig life, which may be 10 years, right, or 15 years, then at the end of the 15 years we will need to incur this expenditure. So we will do the present value for the 15 years and will add up that extra amount to the value of the oil rig. Yes or no? On the
Yes.
date of the capitalization. Yes, this is
Yes,
the
yes.
one thing. Then standard again says, sorry, where is my pen? Here. Then the standard says, whenever there are any changes to this provision liability, because this is a provision only measured at the time of the oil rig capitalization or installation, but in this entire 10-year journey, there might be a possibility that 3 years down the line, 4 years down the line, somewhere management sees some change in this liability, right? Suppose instead of 1 million, which was assumed to be paid at the end of the 3 years, now 3 years down the line or 5 years down the line, this 1 million becomes 1.5 million. Yes or no? Because this is a provision only, there can always be a change in the provision at some future date. So we need to keep an eye on all our provisions, and we need to see if there is any material change, then we need to update the provision amount. That what we generally do for all the provisions at each reporting date. Yes or no? So
Yes.
if that situation arises, then we will revisit our calculation. So whatever the calculation we had performed basis the 1 million on the year one, now after 3 years or 5 years down the line, during the 10-year journey, 5 years down the line, if this amount from 1 million has become 1.5 million or say 2 million, then for the remaining period, the liability should be the true reflection of the revised provision. Yes or no? Yes. How we will do that? So we will again do the discounting of the revised base amount, that is the 1.5 million, for the 5-year period, because the 5 years have already been passed. So for the remaining 5-year period, we will do the present value of the 1.5 million or the 2 million, as the case may be, right? And then suppose that amount comes, say for example, in this case my original amount is 756, and if the provision amount is changed and that amount comes is 821, then whatever is the delta, 821 minus 756, should I record it upfront or not? Yes or no?
Yes. Yes.
Yes. So if I record that, what entry I will be passing on in that case? Again the same entry, PP&D debit
Yes. Yes.
to provision for restoration liability. Now 756 is already sitting in my books, then only by additional amount only I will be passing on this entry at this date, correct?
Yes.
Yes or no?
Yes. Correct. Yes.
So in day 16, are you able to recall? Now, so in day 16 says, as and when there is a change in this dismantling restoration liabilities which you have recorded on the day one at the time of the capitalization of the asset, during the tenure of that very asset, then those changes should be recorded, right, as and when they are incurred, right? So whatever is the remaining term, for that I will do the discounting and will record the additional amount, right? So it is not the rule that it is only recorded at once. It is always revisited during the tenure, and if there are any changes, upward or downward, there may be possibility downward change as well. Suppose instead of 1 million, now the liability comes to 50 lakhs only, or sorry, 5 lakhs only, 0.5 million. So will you do the downward uh, update to the provision and the PP&D as well or not?
Yes.
Yes. So this is all driven by Ind AS 16. Then what is the role of Ind AS 37 here? So the only limited role of Ind AS 37 is that for all these provisions which we are going to record should be recorded at the present value. And luckily, Ind AS 37 also says that discounting needs to be done. And Ind AS 16 also says that discounting needs to be done. In this case, yes or no?
Yes.
Correct. So this is the interplay of the two standards. So you should try your hands on more practical illustrations, numericals, wherever you find in your study material, past examination, so that you are able to correlate the standards together, right? Because in the examination, whenever the question comes, it may say that tell me the treatment according to this Ind AS, but if it doesn't say, then you need to come up with which all Ind ASs are coming into the play in this question, right? Now let's do this example. D becomes subject to an obligating event on 1st of January 2015. D is committed to expenditure of 10 million in 10 years time as a result of this event. An appropriate discount rate is given 8%. Calculate the provision liability as on 1st of January 2015, as at 31st December 2015, as at 31st December 2016, right? So after 10 years, 10 million is the expected outflow. 8% is the discount rate, right? 1st of January 2015 is the date on which we are calculating the present value. Now you need to tell for 3 reporting dates, right? On the 1st of January itself, when the provision needs to be recorded on day 1, right? So day 1 value, then 31st 31st December 15 value, and then 31st December 16 value. You simply need to tell me what would be the value of the provision in your books on these dates. Would you like to try your hands on this quickly? Sometimes doing the calculation in the classroom helps a lot.
Day one, it would be same, 10 million.
Okay.
And then on 31st December, it would be 92
So
lakh
you are saying,
59,000.
so you are saying day one 10 million. Okay. Year end
92 lakh 59,259.
92 lakhs 50
59,000
59,000
259.
259. Okay.
Then it would be 85 lakh 73,388.
Okay. Anybody else? Any other answer? So I think you did a gross mistake here in coming up with the calculation. So what the question says, 10 million in 10 years means 10 million after the 10-year period, right? So 10 million is not payable on 1st of January. 10 million is payable after 10 years. Is that correct?
Yes, I did mistake. Yes.
So if 10 million is payable after 10 years, then the present value of 10 million needs to be calculated and recorded on today's date. And discount rate is given at 8%, right? So what would be the value? So the value would be 46 lakhs 31,935 rupees. How did we arrive at 10 million into this formula, which we have been studying since class 10? Correct? Yes or no?
Yes, yes. I committed mistake now. I understood.
Perfect. So that helps. So because if we do the mistakes in classroom and homework, we will generally not do those mistakes in examination, right? Now, debit, expense, credit, provision. 46 lakhs 31,935, 46 lakhs 31,935, right? Because in the question, it is not clear what is the nature of the expense, right? Obligating event only is the word stated. So we assumed that some expenditure is there which will be incurred after 10 years, right? So we simply said in our journal entry, debit the relevant expense, credit the provision, correct? Now, as at 31st December 2015, we will again do the remeasurement. How we will do that? 10 million into the same formula, but this time the period is 9 years, because 1 year has already been passed. Correct? What would be the amount? 50 lakhs. Original provision was recorded at 46 lakhs. Now the new amount of the provision is coming 50 lakhs. So whatever is the delta is unwinding interest cost for the 1 year. Yes or no?
Yes.
What would be the journal entry to record this? How this 3,70,555 entry will be recorded in the books of accounts? What will be debited? What will be credited? Any idea? So we always need to think through about journal entries, because if we crystallize the concept by drafting the journal entry alongside, then we will not do any mistake in the examination, because our debits credits should be ultra clear. So what is the journal entry in this case? How you will record this 3,70,000? So mathematically you must have been right, but if the journal entry drafted in the examination is wrong, certainly the marks will be deducted. Yes or no?
Yes.
So what would be the journal entry?
The interest
Journal
account
entry
will be
would
debited.
be which account?
Interest account.
Interest account. So P&L account will be debited. Under the P&L account, there will be a interest or finance cost account, right? Finance cost, right? Account debit to provision. That is the same provision, because this provision needs to be reinstated from 46 lakhs to 50 lakh. Correct? Same exercise will happen in the next year. Again, what we will do? We will do the calculation for now 8 years. Amount will be 54. 54 minus 50, 4 lakh. Additional entry would be again the expense to the provision, or expense means the interest expense, right? Now, twist in facts. Would your answer be different if the obligating event in respect of the decommissioning liability is for PP&D rather than some other revenue nature expense? So in that case, what will happen? The entries will change, right? So the amount or the calculation will remain same, right? So 46 lakh would be the
Yes,
present value.
PP
But
would be
instead
debited.
of debiting the P&L or the expense account, what we will do? We will debit that very plant or machinery or the PP&D to which this decommissioning is related to. Yes or no?
Yes.
So, although I have written a PP asset account debit, but what it would look like in my fixed asset register, FAR. So, in FAR, I have a, say, machinery, right? I have, say, land, right? I have, say, electrical installations. Then I have another account, decommissioning liability for machinery. Yes or no? So this account will eventually be used here in my journal entry. Debit the PP&E asset. Which PP&E asset? The machinery. But do we practically debit the machinery account itself? No. In practice or in practical life, we generally create a decommissioning liability account within the FAR for this machinery, so that we are able to identify clearly the movements in the decommissioning liability throughout the life, right? So this decommissioning liability for machinery asset account, that is, this is asset account sitting in my fixed asset register, will be debited here and the provision will be credited here. Is that clear?
Clear.
Anybody has any questions, doubts here? Now, again, as at 31st December 2015, what we will do? We will calculate it for 9 years instead of 10 years, because 1 year is passed. So 50 lakh is the amount, 46 the original. The delta is interest cost again, and the balance is 50 lakh. Now, what would be the entry in this case for this 370?
Same profit and loss account, interest account, debit to provision.
Right. So, debit profit and loss account to provision 370, and this expense would be the interest expense basically, which generally we used to call finance cost, right? Sophisticatedly, correct? So this would be the entry, but there would be an additional entry because we have created a PP&E. So for that PP&E, we need to do the depreciation. So what would be the depreciation? So asset was capitalized, or decommissioning liability asset was created for what value? 46 lakhs, assuming the life is 10 years. So SLM method, this would be the depreciation, which will additionally be recorded in the books of accounts now.
Yes.
Right. And this expense is what? P&L account debit, right? Depreciation account.
Depreciation account debit.
To accumulated depreciation account, correct?
Yes.
Same exercise will happen in the next year. Again, we will do the recalculation for 8 years. Amount will be arrived at 54. 54 minus 50. 4 lakh is the delta. 4 lakh will be recorded as the interest cost, that is finance cost in my P&L. Provision will be uplifted by 4 lakh. And again, the same depreciation entry will be passed on in the current year, right? So this is how we are going to do the journal entries. Although we might be clear in the concept, we might be clear or accurate in the calculations, but if we are mistaken in the journal entry, then we will lose the marks, right? Because at the end of the day, journal entry, only is important, right? If the entry is wrong in the books of accounts, everything is wrong, correct? Okay. Let's do this question now. X Solar Power Limited, a power company, has a present obligation to dismantle its plant after 35 years of useful life. Right? 35 years is the useful life. At the end of that period, power company needs to dismantle the power plant which they have installed. X Solar Power Limited cannot cancel this obligation or transfer it to the third party. X Solar Power has estimated that the total cost of dismantling is 50 lakh and the present value is 30 lakh. Right? So after 35 years, 50 lakh is payable, and if that 50 lakh is converted into the present value, right, then 30 lakh is the value which is also given in the question. Based on the facts and circumstances, X Solar Limited considers the risk factor of 5%, that is the risk that the actual outflows would be more from what the expected present value is. How should X Solar Power Limited account for the obligation? So before answering this question, let's go back to the concept slide. So this was our concept slide. Measurement of the present value. What all we need to keep in our mind? Number one, discount rate shall be the pre-tax rate. It should reflect the current market assessment of the time value of money, and it should also factor in the risk specific to the liability, right? If risk is not factored into the discount rate, then it needs to be factored into the outflow amount. And if it is factored into the discount rate, then the risk should be the risk free, right? This is what we have learned. Now, basis on this, you need to tell me how you are going to do the adjustment of the 5% risk factor in this.
Sir, here we will add that risk factor of 5%, sir. 15 lakhs, it will come on the present value of 30 lakhs. So 30 lakhs, 50,000, we will book the provision.
Okay, so what would be the total provision in that case?
31 lakhs, 50,000.
31,50,000 would be the provision you will be recording on the day one, adjusting this 5% variability risk, right?
Yes, sir.
Okay. Any other answer? Who was speaking? May I know?
Sir, my Swaminathan, sir.
Ramanathan. Okay.
So actually, my mic was not working. So I switched over to different
Okay.
system now.
Okay. Okay. Right.
Yeah, I was responding through chat actually earlier.
Yes. I was seeing your responses. Okay. The obligation should be measured at the present value of the outflows. That is the 30 lakhs, because 30 lakhs is already given in the question, right? So we will simply add the variability into the 30 lakhs. That is 5% of 30 lakhs, 1,50,000. The total amount comes to 31,50,000, right? Now, there are many ways to adjust, right? Suppose in this question, if this present value was not given, possible or not possible? Possible, right? Only
Yes,
the
sir.
50 lakh future value is given, which will be discharged at the end of 35 years, right? Now, in that case, what we will do, because the risk free rate is given in the question at 5%, right? And sorry, risk adjustment is given at 5%, right? So, what we could have done in case the present value was not given?
Yeah, we have to compute, sir.
We have to compute. So in that case, because with limited facts in the question available, right? So we would have said that because 50 lakh is the expenditure cash outflow expected at the end of the 35 years, so we need to calculate the present value of 50 lakhs first, because the rate at which it needs to be discounted is not given in the question, nor the present value, right? So assuming a rate say of 9%, 8%, 7%, which is reflecting the market conditions, time value of money, we are doing the present value of 50 lakhs. Then we would have arrived at a present value at some assumed rate by quoting the assumption in our solution, and then we would have added this 5% risk factor. Is that correct? Right?
Yes, sir.
Another twist in this question itself. Suppose present value is given in this question of 30 lakhs, it stays here, and the wordings here of saying the 5% risk factor, that the risk that the actual outflows would be more from the expected cash outflow. What would be your answer in this case? So in the question, the fact was 5% is the risk for the present value. Now I have changed the word. Instead of saying it on the present value, I am saying 5% is the risk which by which the cash outflow may vary. Now, cash outflow means cash outflow at the end of the life, right? Which is 50 lakh. So 50 lakh may vary by 5%, right? Yes or
Yes, in
no?
that case, yes, we would add 5% to 50 lakh rupees.
Right. Now, because for 50 lakh, the present value is given at 30 lakh, and 50 lakh could vary by 5%. So, how much is the 5% of 50 lakh? 2 lakh 50,000 maybe, if I'm
Yes,
Yes,
sir.
correct.
2,50,000.
Right.
Mm,
So, if 30 lakh is the present value for 50 lakh, right? Then what would be the present value of 2 lakh 50,000? Can you do a pro rata?
1,50,000.
1,50,000. So in that case, what would happen? We would have added this 1,50,000 to 30 lakhs and arrive at the answer 3150 lakh 50,000.
Yes.
Right? Now, why I'm doing all these tweaks and twists? Because in examination, we do not know how the language or drafting of the question is, right? So we shouldn't be strict to a particular solution that, if the risk weight is given, we will simply add up to the present value. No, that's not the rule. The rule is basis on the situation where and how this needs to be adjusted, that needs to be understood clearly, right? So if the question is saying 5% is the risk on the present value, then we will add on present value. If the 5% is the risk on the cash outflow, then we will upgrade the cash outflow first and then we will calculate the present value. But within this question, because the rate of interest is not given, only the present value is given. So what I will do, I will do the addition of 5% or calculation of 5% on the 50 lakh, and then I will do the pro rata present value, because at the rate at which 50 lakh is discounted to 30 lakh, right? That rate I do not know in this question, right? Certainly I can calculate because I have the 35 period, given in the question. But instead of going into that calculation and wasting time, can't I do simple pro rata? 100 discounted at a particular rate to some value and 1,000 discounted or 500 discounted, for the same period, same rate, will fetch the same result? Yes or no? So pro rata will also give you the same answer. Otherwise, if you want to do calculation this way, that you need to calculate the rate first. At what rate of interest for 35 years 50 lakh would be converted into the 30 lakh present value? You can do that as well, and then you can apply the calculation on 2,50,000. Again, you will come down to 1,50,000 only, right? So it is all just understanding the given facts and coming up with the right approach to adjust these amounts. Correct? Is that clear?
Clear.
So Shalinder is saying he's facing some lagging issue. Is anybody else also facing?
No, it's okay from mine.
Okay, so I think it's internet issue at Shalinder's end in that case. Okay. Measurement, other rules. Future value. Future events that may affect the amount required to settle an obligation shall be reflected in the amount of the provision where there is a sufficient objective evidence that they will occur. So let me go back to the slide so that you know what we are talking about now. So first of all, we understood the best estimate, most likely method, expected value method. Then we understood how the risk needs to be adjusted. Then we understood how the present value needs to be calculated. Now we are talking about this item, future value, right? So future events which may happen in future, right? These events have not yet occurred, right? Those are the future events which will happen in future, but they may affect the amount required to settle an obligation. Then it shall be reflected in the amount of the provision where there is a sufficient objective evidence that they will occur, right? So it is most likely that future event will occur. Correct? So if they are occurring and this is most likely, then what the standard says, the effect of those future events will be adjusted for the estimation of the provision amount. Correct? What could be the example? the effect of a possible new legislation is taken into consideration in measuring a existing obligation when sufficient objective evidence exists that the legislation will is virtually certain to be enacted. How many of you remember in the previous session I have took a example or a question? Give me a second. What is happening over here?
Sir, actually, what is happening? Sir, your voice is coming clearly. There is no doubt, but your action, no, that is lagging. That is not properly coming.
Okay, okay.
The delay in picture, but
Delay in
voice is
picture.
clearly is we can able to hear. Voice is very perfect.
Okay, okay, okay. So basically, the drawing or the lining which I am putting in on the slide is coming a bit with lag, right?
No, no,
No,
no,
sir,
no.
presentation is
I'm
fine.
not
Your motion
talking about,
is
sir. Sir, your video picture,
Okay, video. Okay,
your
Presentation
video
is fine,
is
sir.
complete.
we are not able to correlate the movement, so that's why it will be
Yeah.
more experience. Yeah. So
okay,
just
okay, okay. So let me turn off the camera and then turn on quickly.
Okay, sir. This problem was continuing from the beginning, I believe.
Okay, okay.
yes.
Now it is better. Is it better now?
Yes, sir. Better.
Okay. So what I was talking about is in the previous session, I have taken a example where the chemical factory was polluting the nearby river, right? And there was no law, and hence there was no obligation on the part of the company for doing any cleanup or etc. And because there was no law, so there were no fines and penalties as well expected, right? And hence the company was not supposed to do any provision in the books of accounts. Are you able to recall that example?
Yes, sir.
Yes.
Yes. Now, suppose a law by 31st of March has been drafted and put in front of the Parliament House for getting it approved, right? And in one of the house it is passed, and in another house it is subject to be scheduled in upcoming meeting, which is scheduled in say first week of April, right? Or maybe second week of April. But we are preparing the financials for 31st March, and basis on the current news outflow, it is highly likely that this law will be passed, right? Now the company which has been polluting the river until now was not recording any provisions in the books of accounts for any of the associated liabilities they might incur because there were no laws. But because the law, although not yet enacted or notified, but is expected to be enacted and notified in the coming days, right? After the end of the 31st March, right? So, in that case, what do you think? Whether the company should come up with the calculation of the provision and record the provision for the cleanup cost or any of the penalties or fines, or the company should say that because the law is not enacted, so we will see it in the next year. What is your thought?
Sir, now there is a most likely it's going to happen. The law, the first house is sanctioned. The second house is also is going to approve.
Hmm.
Then we need to provide the provision for that.
Hmm. So that's what is the future event, right? So event is uh, what inaction of the law, right? So the law will be enacted in the future, right? Not yet enacted. But what is the past event? Past event is the river has already been polluted. By virtue of the past event already incurred and the expectation around the law will be enacted, there arises a present obligation on the part of the company. Yes or no?
Yes, sir.
Yes. So because past event is already incurred before 31st March, and future event, that is the law, will be notified in the April, right? And it will be applicable, right, on the company because they have already polluted the river, right? So company will be required to do the cleanup, right? So they will need to come up with the provision in that case. So that's what the standard is saying, that future events that may affect the amount, future events that may affect the amount required to settle an obligation, right? So obligation was there, yes or no? Yes, obligation to was there, but because there was no law, so company was not binded, right? So now because of law, that binding is coming into play, and hence company will need to incur some amount of expenditure which the company was not expecting to incur. So earlier the amount was zero because company was not planned to do anything. Now because of this law being enacted in April month, there would be a onus on the company. So it will bring the amount of the provision from zero to something, right? So that is the future events that may affect the amount required to settle an obligation shall be reflected in the amount of the provision where the sufficient objective evidence that they will occur. And now because sufficient objective evidence, what does that mean? That means this is highly likely that this will happen. Now, the new law which is already passed by one of the house and is subject to be passed in the upcoming meeting in the second house, then it will become the law, right? So this is highly likely, right? And basis on the news flow, basis on the experts opinion, everybody is talking in the town about this new law getting enacted, right? So hence the company is obliged to consider this and make a estimate. Let's do this. X Chemicals Limited engaged in the chemical industry causes environmental damage by dumping waste in the river near its factory. It does not clean up because there is no environmental legislation requiring the cleanup, and the X Limited is causing the damage for last 40 years. So past event already occurred or not?
Yes, incurred.
Past event has already been incurred, correct?
Yes, sir.
As at 31st March 2002, the state legislature has passed a path breaking legislation requiring all polluting factories to clean up the river water already contaminated. The formal gazetting notification of the law is pending. How X Limited should deal with this situation, right? So the same thing, whatever we were talking about, the obligating event is the contamination of the water, right? This is the past event, correct? And because of the virtually certain legislation requiring the cleanup, an outflow of resources is certain. So outflow of resources is probable. It is possible to arrive at the best estimate cost of the cleanup activity. Now, how the cleanup needs to be done? So the company will ask a company, another vendor who is into the business of cleaning up the river, and ask for an estimate. Yes or no? Possible. So whatever the estimate is given by that vendor will form, the basis for measuring the provision, right? So a provision should be recognized in the books of X Chemical Limited for 2001-2002 basis on whatever the quotation they are receiving from the vendor who is into the business of this cleanup activity. Yes or no?
Yes, sir.
Right? So this is how we are going to include the future events which are affecting the provision amount, if we have already recorded or even if we have not recorded, and they are becoming certain now because of this. Now the last item which I spoke about is the expected disposal of assets, right? So sometimes companies comes up with certain restructuring within the organization, right? And if they are doing the restructuring, there might be certain property, plant and equipment, furniture or other fixed assets which the company may find useless going forward post restructuring. So what they intend, they plan or prepare the list of all those assets and plan them to dispose, right, and realize some value, right, because these assets will be disposed of by virtue of the restructuring plan, otherwise they might not have been disposed of, right. So we were thinking that whatever the restructuring provision is, which will be estimated for the restructuring plan, should be netted off by the expected realized value of the disposal of assets. So standard is very clear. Standard says any gains from the expected disposal of these assets shall not be taken into account in measuring a provision, right. So these are separate items which will be accounted for and governed by Ind AS 16, correct. So they are not considered in netting of the provision which we are calculating or measuring for our restructuring plan under Ind AS 37. So let's do this question. At the end of the year 2001, an entity is demonstrably committed to the closure of some of its facilities, having drawn up a detailed plan and made appropriate announcements. The expected impact of the plan is as follows. Committed closure cost 10 lakh and gain from sale of the property, plant and equipment 2 lakh. The provision required at the end of the 2001 is rupees 10 lakh, ignoring the discounting for the sake of simplicity, right? If the tenure involved is more than 12 months and the discounting is a material, then we will do the discounting as well in this case. But for the sake of simplicity, we are ignoring. And the expected gain on the sale of the property, which will be dealt separately under the derecognition criteria of Ind AS 16, hence will not be netted off. So the provision will be recorded at what value? 10 lakhs only, right? It shouldn't be the 8 lakhs, saying that because by virtue of the closure of the factory, 10 lakh is the cost which we are expecting to incur, but we will also realize some 2 lakh gains by selling whatever we have in this factory. So hence the net provision should be the 8 lakh is in the books. No, India's 37 is very specific about this, that provision should be recorded at gross provision amount only. Is that clear?
Clear.
Yes, sir. This is what discussed in the beginning of the class.
Correct. So all those items which we were just talking about when we started the session, we have just, covered all these items, right? Now there are some additional concepts which we will cover. So let's have a break for 10 minutes now. Let's be right back at 8:45, if that is fine. 8:33 is now.
Yes, sir.
Yes.
Thank you. Sir,
Yes, sir.
please try to switch over your networking, sir. Try to adjust
Sure.
something.
Sure.
See, actually, your video is not coming as per the voice. See, like the firecracker, no, the light is coming first. The second is sound is coming like that.
Okay. Let me drop and rejoin in that case, maybe.
So switch to 5G, sir.
It's already 5G. Ashok ji, break start. So the next topic is the reimbursements. So what reimbursements means? So sometimes it happens that we are expecting a reimbursement of the expenditure which will be incurred for which we have recorded a provision, and reimbursement will be expected from some party, right? So for example, if we have created a provision of rupees 100 in our books of accounts for a particular expenditure, and because for that expenditure, as and when it is incurred, right, there is a reimbursement also expected from some third party or other party, say for example, say for rupees 50, right? So if we incur the expenditure of rupees 100, we will get the reimbursement of rupees 50, right? So 50% of the expenditure incurred is reimbursable to us, as per the contract between the two parties, right? So in that case, reimbursement will also be a crucial factor and accounted for, right? So the standard says, we will do a practical around this. So let's try to understand what the standard is saying around this. So standard says, in case of the expenditure required to settle a provision is expected to be reimbursed by some other party, then the reimbursement shall also be recognized when and only when it is virtually certain that the reimbursement will be received if the entity settles the obligation, right? So let's do the question first. X, which is a beauty solutions company, right, is selling some cosmetic products in the market, right? For example, makeup kits, shampoos, soaps, face washes, face creams, whatever, right? Under the brand name B, right? So this is a beauty solutions company who has a brand B, and under that brand they are selling various cosmetic products, right? But they are not getting these manufactured by themselves, rather they have outsourced the manufacturing process to some other company, that is the Y Limited. So Y Limited is basically a contractual company, contractor, who is doing the manufacturing of beauty solutions limited's products, and then once those products are manufactured, they are labeled as brand B, right, as per the agreement. It has an understanding and foreseeable agreement with Y Limited, right, that if the company becomes liable for any damage claims due to any sort of skin injury or any harm to any of the customer by virtue of the use of these cosmetic products, then 30% of the amount will be reimbursed to it by Y Limited, right? So, for example, if a customer comes and says that they are getting some side effects, serious side effects, and they want a particular damage cost, say 100 rupees from the company, then out of that 100, 70 will be paid by X Limited and 30 will be borne by Y Limited. Although the primarily beauty solutions will only be settling the 100 rupees, but they will be claiming 30 rupees from the Y Limited as per the contract they have in place, right? During the financial year 2001-2002, a claim of rupees 30 lakh becomes payable to the customer by X Beauty Solutions Limited. How should X Beauty Solutions Limited account for this claim that becomes payable? So, what are the journal entries X Beauty Solutions Limited will be passing on in its books? What do you think? Yes. Any answers?
Yes, sir. Damage the part 30 lakhs that the X Limited has to create the provision.
Mm-hmm.
As well as for from Y Limited, the X Limited the will receive the 30% reimbursement, which means the out of 30 lakhs, 3 into 30 into 90 lakhs.
9 lakhs.
Sorry, 9 lakhs will be reimbursement from them. That will be treated as a asset separately. The provision will be treated as separately. There is no netting off.
Okay. So, what is the journal entry?
Um, claim account debit to provisions for claim account.
How much? 30 lakhs?
30 lakhs.
Okay. Okay. Entry number 1. Any other entry?
Entry number 2 need to be passed for 9 lakhs rupees.
What would be the entry?
Claim receivable will be credited.
Claim receivable 9 lakh. Okay. 2.
2 I am not there, sir. That P&L?
To P&L.
No, not a P&L. From that limited, that Y limited.
To Y limited. 9 lakh. This is or any other thoughts? Okay. See, basis on the contract between the Beauty Solutions, X Beauty Solutions Limited and Y Limited, the enforceable agreement, establishes the right to receive 30% of the claim amount, right? So the claim amount is 30 lakhs. So 30% of that is 9 lakhs, right? It shall be recognized as a reimbursement right and the provision will be recognized for 30 lakhs, correct? So the provision will not be netted off. So provision will be recorded at the gross amount of the provision because that is the primary liability of the Beauty Solutions Limited only, right? What is the logic behind not netting off, which the standard is not permitting, right? So standard is saying that the liability of 30 lakh is for B Beauty Solutions Limited. So the liability should be stated at gross in the balance sheet, 30 lakhs. So it shouldn't be netted off with the 9 lakh reimbursable amount from the contractor or manufacturer, right? So in the balance sheet, the provision will be stated at full 30 lakh value. So the journal entry would be claim account or P&L account debit to provision for claim, right? 30 lakhs. So provision we have created in our books of accounts. Now, the reimbursement right shall be treated as a separate asset in the balance sheet and shall not offset the provision, right? So provision will be recorded at 30 lakhs and the separate asset will be recorded at 9 lakh, which is reimbursable. Now, in the statement of profit and loss, however, the expense may be presented as 21 lakh after offsetting the reimbursement, right? So in the P&L, maybe net of the expense can be presented because on one hand, we are booking an expense of 30 lakh and on another hand, we are booking a receptibility of rupees 9 lakh. So in net, 21 lakh would be the P&L impact, right? So that can happen in the P&L, but in the balance sheet, we cannot do the offsetting. That's for the standard is saying. And what would be the second entry in that case? So the second entry would be, Y limited debit, because Y limited is the party from whom we will be receiving the amount. So we are simply debiting the account of Y limited by 9 lakhs to reimbursement against claim account. That is the P&L account, right? So P&L account we are crediting. So on one hand, 30 lakh we are debiting in the P&L account. On another hand, 9 lakh we are crediting in the P&L account. So net impact on the P&L account is 21 lakh, which standard also allows to present on net basis in the P&L, but in the balance sheet, separate presentation is the requirement. Is that clear?
Yes, sir.
Okay. Now let's come back to our concept. So concept is reimbursement in case of any expenditure which we expect to incur is getting reimbursed and the reimbursement is virtually certain. Now, how virtually certainty is established in our question? By virtue of the contractual agreement? Yes or no? Because contractual agreement is a legal binding on the other party, right? So that is virtually certain. So because it is virtually certain, then only the receivability is recorded in the form of asset. If it is not virtually certain, then the second entry will not be passed unless and until it becomes virtually certain. Is that clear? Suppose in my example, if there was no agreement in place, suppose this agreement was not there, right? Then whether you can say it is virtually certain to receive the 30%?
No.
No. But 30%, if company goes and ask Y Limited that boss, we have experienced this issue very first time in our last 10 years history. So I am getting this 30 lakh, claim. And since the quality of the product which you have manufactured was not up to mark, which has come after the survey and in the investigation. So let's share this burden. And will it be okay if you share 30% burden? Y Limited says, okay, I will be okay to share the 30% burden. So until that discussion happens and Y Limited agrees or confirms, until then, we will not record the reimbursable asset, right? Only the 30 lakh provision entry will continue to be there in our books of accounts. But as and when Y Limited agrees, then it becomes virtually certain, and hence on that very date, we get the right to record the asset as well in our balance sheet, right? So for recording the asset, which is the reimbursement, receptibility from the third party, that is an asset. So asset can never be recorded in the books of accounts unless and until it is virtually certain. Is that clear? Now, the reimbursement shall be treated as a separate asset. Again, the standard is saying shall be treated. It means it is a mandatory, right? We cannot do the net presentation in our balance sheet. So, a provision and the asset, that is the receivable from Y Limited, are treated separately in balance sheet. And the amount recognized for the reimbursement shall not exceed the amount of the provision. So, in my example, instead of 30%, suppose the agreement says 120% of the amount, because 20% is a additional damage which is there to my brand value, right? So 20% additional amount I am seeking from you, right? And it is contractually driven. Then what would be the amount for the second entry?
So second entry will be 30 lakhs only.
30 lakhs only, right? Because the standard has casted a limitation that the reimbursement cannot exceed the original amount of the provision. So if the original amount of the provision is 30 lakhs, then reimbursement right, even if the right is there for receiving extra amount, that extra amount will not be considered for our accounting purposes, right? On as per Ind AS 37 on our balance sheet, right? So we will record the asset as well. That is the receivable from the Y Limited for 30 lakhs only. But the day when we receive the 120%, which will be how much? 36 lakhs, correct?
Yes, sir. On the day of receipt, we will book the entry for 36
Right.
lakhs.
So on the day of the receipt, what would be the journal entry in that case?
Yeah, bank account, we will see, since we debited that Y Limited account, we will credit Y Limited and debit to bank account. ₹36 lakhs.
Correct. So bank account debit to 36 lakh as and when we receive the amount. Y Limited, because we have already created a debtor, so we will credit by 30 lakhs and to P&L by 6 lakhs, being the
That is other income, sir.
of course other income. So being the claim amount as per the contract received from Y Limited, correct? Right. So 6 lakh would be the income recorded in the P&L on the date of the receipt, right? It will not be accounted for as and when the claim has arisen. So on the date of the claim, only the 30 lakh would be the amount maximum we can record in the form of asset receivable from the Y Limited, right? Now, standard says in the balance sheet, it shall be treated as a separate asset and it shall not exceed the original liability. And in the statement of comprehensive income, what do you mean by comprehensive income? It means PNL or it means OCI?
OCI.
No. Comprehensive income is like this, comprehensive income. Then there is a PNL and then there is a OCI, right? So PNL plus OCI forms comprehensive income, right? So whenever we call comprehensive income, we generally mean PNL only. We never mean OCI. Because if we mean OCI, we will say in the statement of other comprehensive income. Clear?
Okay, sir. Got it, sir.
Right? The expense relating to a provision may be presented net of the amount recognized for a reimbursement, right? So in the P&L statement, in the statement of the P&L, the expense 30 lakh net of 9 lakhs, 21 lakhs can be presented, right? But in the balance sheet, it will be presented on a separate gross basis, right? Is that clear?
Yes, sir. On the second case, it will be nil on the comprehensive
Yes.
income.
Right. So in the second case, because if we are receiving 120%, but the standard restricts up to 100% only, so we are recording the receivable of 30 lakhs only. So 30 lakhs minus 30 lakhs in the P&L, the impact would be nil. But on the balance sheet, there will be separate two items: 30 lakh receivable from Y Limited against the claim and provision for the claim, 30 lakhs. Is that clear?
Yes, sir.
Perfect. Now, is it always that provisions needs to be, once measured will never be changed on next reporting dates, or do we need to change the provisions basis on the recent developments at each reporting date?
Yeah, each reporting date we have to see what is the recent development. Accordingly, we have to adjust to the provisions.
Right. So standard uses the word shall. Provisions shall be reviewed. That is mandatory. Right? At the end of each reporting period. What do you mean by reporting period? Is it 31st March always?
No, sir. As per the financial reporting ended.
Right. So as per the financial reporting end date, for example, if there is a company who is producing the quarterly results, then it will be each quarter.
Yes, sir.
And if the company is not producing quarterly results because it is not equity listed, but it is debt listed and producing half yearly results only, then it will be half year for that company.
Yes, sir.
And if the company is neither having equity listed nor having debt listed, and they are a private limited company and only producing annual financial statements once in a year, then it will be year end only. Correct? So reporting date or reporting period could vary basis on what frequency the company is preparing the and publishing the financial statements and financial results, right? So reporting period is not fixed in terms of date, it is fixed in terms of as and when the company is producing the financial statements, correct? And at each reporting date, it is company's management's duty to review all the provisions sitting in the balance sheet. So to understand if they are continued, required to be continued at the same value, or if they are needs to be reversed, or if they needs to be revised in terms of the estimate, right? Once this exercise is done, then we will say yes, all the provisions are reviewed and updated accordingly for each reporting date, right? If any of the provision is no longer probable that there will be any outflow of resources, then what will happen? The provision will be reversed. So do we reverse the provision?
Yes, sir.
Yes. So as and when, it is expected that there wouldn't be any outflow expected now anymore, right? So we will reverse the provision. For example, the case which was pending in the court is decided in favor of us. Because it is decided in favor of us now, so there wouldn't be any outflows expected. Because there are no outflows expected, so whatever the provision we had recorded in the absence of the court order, now the court order has been received, so provision will be reversed because it is no more required to incur any expenditure. If there is a change in the provision resulting from a change in the discount rate, suppose we had discounted initially at a 10%. Now in the economy, the discount rate is getting changed, right? So we need to estimate, revise the estimate basis on the new discount rate. So what should we do? Should we do it from the day one, or should it be done from now onwards for the remaining period? What do you think?
Sir, it is a prospective effect, not retrospective.
Correct. So it is a prospective effect. That's why the standard says it should be treated as a change in accounting estimate, right? Prospectively, right? So as and when the discount rate is getting changed, so for prospective period, for the remaining period, we will revise the discount rate and revise the estimate accordingly, right? Once the amount of the obligation is crystallized and there is no uncertainty left with the obligation, the liability is no longer a provisional liability, it has become a final liability. And because now it is no more provisional in terms of timing and amount, the same should be reclassified from the provision to the liability. So this is a classification change, right? So provisions
Which
are being classified under the provisions, correct? But as and when any liability gets crystallized, right, there is no more uncertainty left, be it related to the measurement or be it related to the timing, then it becomes a clear cut liability, and hence provisions will be reversed and liability will be recorded, right? And this
yeah,
is the normal
which
exercise
means
which we are doing under IGF as well. Yes, please go ahead. Go ahead, please.
sir, which means we will be classifying the provision into the firm liability when the liability obligation is crystallized.
Yes. So whenever the obligation is final, right? So earlier we used to measure. So let me correlate this with an example. Suppose there was a court case, right? And the outcome, the decision was not yet arrived. So basis on the best estimate, we thought if we lose the case, we will be incurring say 50 lakh. So 50 lakh provision we had recorded in our books of accounts, right? And we have prepared and finalized the books of accounts. Now, in the next year, the court decision has arrived and we actually lost the case. But the liability in the order passed by the court is not 50 lakh, but either it is 40 lakh or it is 60 lakh, for example, right? So now in this case, what do you think? It is a crystal clear liability or it is still a provision?
Yeah, now it is a crystal clear liability, so that we will move from provision to
Right?
fixed the firm liability.
Correct. So what we will do, we will reverse the original provision entry, right? And in our balance sheet, the provision will no more be coming, but the liability basis on the order of the court at 40 lakh or 60 lakh, whatever it is, right? We will record, right? So we will simply say this is our liability which we need to pay to the Mr. X, right? So we will credit the creditor and record the expense in the P&L, and we will simply reverse the original provision which we had recorded. Is that clear?
Okay, sir.
Let's do this. Customer X has made a claim of rupees 2 million for the liquidated damages, and the entity is disputing the amount of the claim due to the uncertainty involved in the amount payable. The entity recognizes this as a provision. After negotiation with the customer, the amount is agreed at 1.5 million. As there is no more uncertainty involved relating to the amount payable, it is no longer meeting the definition of the provision and hence should be reclassified from the provision to the appropriate category within the liabilities. So earlier, the 2 million was the expected amount which we had recorded as a provision, but we did a out of court settlement with the customer, and customer agreed that I will withdraw the case. You pay me 1.5 million upfront, right? Or maybe next week or next month, right? Whatever the time duration. So the provision of 2 million will be reversed and the liability of 1.5 million will be recorded. Yes or no?
Sir, your voice is breaking, sir, actually. Last 2 to 3 minutes.
Okay. Let me turn off the camera for a minute. Is it better now?
Okay, sir.
Hello? Is it better
Yes,
now?
sir. Yes, sir. Better now.
Okay. So what I was saying, so in this example, 2 million was the original provision which we had recorded. And once we have done the out of court settlement with the customer and the customer agreed to receive 1.5 million and we also agreed to pay 1.5 million. So there is no more uncertainty around the estimate, right? Because the liability is getting crystallized now. So we will reverse the 2 million provision and we will record the 1.5 million liability. Is that clear?
Yes, sir. Clear.
Right? So this is how the standard says. So standard says as and when the uncertainty around the amount or timing, is no more existing, then the provision needs to be converted into the liability, right? So this is no more a provision, right? Then the standard also talks about specific guidance for which we are not expected to record any provisions in our financial statements. For example, future operating losses. What future operating losses means? So
See,
if the
company is
company,
expecting some losses.
yes, please go ahead.
The company is expecting losses on the near future. That based on that the loss they are going to estimate. Now we should not create any provision for it.
Correct. Because if we go, uh, and record the provision for the losses which we are expecting to incur in the future by, running our business, then how long we need to go? Should we record the provision for the next quarter, next half year, next 1 year, next 2 years, next 5 years, next 10 years, right? The avenues open up, right? So standard, although we were not going to do record this, but standard also wants to be doubly sure. So that's why standard is saying not to record any provisions for below items. Number one, future operating losses. So whatever the losses we will incur in future, right? If we are not able to generate enough sales, if we are not able to generate enough margins on our sales, and our administrative costs are getting higher as compared to the manufacturing and selling cost, and hence by virtue of that we are incurring some losses, but those losses, as and when they are incurred, will automatically be reflected in our P&L, right? Negative P&L. But we don't need to record the provision for that, right? And quite logical. Same goes for currency risk. So currency fluctuations will happen in the market, right? So if we are having any debtors or creditors in the foreign currency, right? So what we are doing at present, we are simply reinstating them at the balance sheet date, right? So whatever is the closing rate of that particular currency is on the balance sheet date. On that very date, we are simply reinstating our debtors creditors. Yes or no? Yes, right? But because currency will fluctuate in future and it is possible that we incur loss on that currency movements in the future, so should we record a provision for that? No. So provision is not required to be recorded. Same goes for other items. Political risk. Today is a one particular government operating. Maybe some election comes in, and then next government appointed will be a new government or some other government. Now we have very good connections with this political party, but we might not have good connections with the another political party, and there are high chances that this political party will not be winning the elections next time. So let's create a provision, because we will lose some business because of change in political parties. No, we are not going to record any such provisions in our books of accounts. Maintenance or refurbishment of the property, plant, and equipment. So if there are any fixed assets capitalized in our books of accounts, so as and when any repair or maintenance expenditure are incurred, we record them, but we don't need to create any provision for the expected maintenance or refurbishment, right? If we are doing any restructuring, right? So any general restructuring projects, right? We are not going to record any provision unless and until any affected persons because of this restructuring are, identified and communications negotiations started. For example, severance pay to the employees who will be laid off. Then provision for that severance pay will be recorded, right? And other general business risk. So any other risk which business has. So business has a lot of risk. We are not going to record the provisions for all those business risks, right? So this is the general and specific guidelines by the standard, so that we don't mess up with the provisions in our books of accounts unnecessarily recording provisions for anything and everything. Correct? So let's do this question. X Packaging Limited has two segments, packaging division and the paper division. In March 2001, the board of directors approved and announced a formal plan to sell the paper division in June 2001. Operating losses of the paper division are estimated to be approximately 50 lakhs during the period from April to the expected date of the disposal. Management of X Packaging Limited wants to include the future operating loss of 50 lakh in a provision for the restructuring within the financial statements for the year end 31st March 2001. Can X Packaging Limited include these operating loss in the form of the provision for restructuring? What is your advice?
Sir, my advice is to include this operating loss of 50 lakhs. The reason is that the board of directors already approved in March 2021. Also, it is announced the plan to sell the division. So that the which means that the past event has happened. So here we can provide the provision for this loss.
Okay. So what we just discussed is specific guidance. Do not provide for future operating losses, right? The standard is specifically asking, do not make a provision for future operating losses, right? And this is what? Future operating losses only. Until the division is sold out, we are continuing the operations, and by virtue of continuing the operations until we find a buyer to buy this division, 50 lakh is the expected loss which will be incurred, right? So 50 lakh is the future operating loss only. Yes or no?
Yes, sir.
This will,
But I am thinking in line with I am thinking in line with that the board of directors already approved and also announced the formal plan to sell
Doesn't matter, no?
the division.
No. So no. So you are getting confused with the altogether different concept. So the concept of restructuring is whatever the additional cost the company will incur if they go ahead with the restructuring plan, right? So even if they do not do the restructuring, even if they do not sell this paper division, the 50 lakh operating loss will continue to happen, yes or no?
Yes, sir, that is true.
That is true. Now, by virtue of acting prudent, company plans to sell or do some restructuring, and for carrying out that restructuring, additional 10 lakh cost is being incurred. So that 10 lakh is the provision which we need to create in our books because of the proceeding with the restructuring plan. Because if the restructuring happens, then additional 10 lakh will be incurred. If the restructuring doesn't happen, this 10 lakh will not be incurred. But this 50 lakh is the operational loss. Anyway, it will happen whether to go ahead with the restructuring and sell this division, or whether not to go ahead and sell this division. Right? This is the operational loss of this division. So operational loss we will never record in the provision. Otherwise, why to talk about this particular division only? If a company is running into the losses, then have you ever recorded the provision for the year-end losses? Yes or no?
Yes, sir.
You record provision for the year-end losses.
No, sir. This 50 lakhs we will not record. If any cost incurred, if you're going to incur, then that cost we can provide the provision.
Correct. So provision means the additional cost by virtue of proceeding with the restructuring plan, right? It is not about the normal business loss which will be incurred, right? So business, if the company is running into the losses, company never can never record the provision for the year-end losses, provision for the quarter losses, provision for the next year losses, right? We never record that. Correct? So
Okay, sir. Got
standard
it, sir.
states that provision should not be made for the future operating losses, since Ind AS 37 prohibits the recognition of the future operating losses. So X packaging should not include these future operating losses in a provision for restructuring, even if those losses are related to that very disposal group, right? Okay. Repair maintenance. What do you think? If there is a repair maintenance carried out in any of the plant and machinery, so when those repair maintenance expenses are booked, as and when they are incurred, or do we need to create a provision for the repair maintenance, and as and when they are incurred, then we will reverse the provision and record the actual expenditure? What do you think?
No provision will be done for repair and maintenance. As and when the expenses happen, we will book that expenses.
Correct. So we generally do not record any provisions for repair and maintenance, right? So as and when repair and maintenance expenditure is actually incurred, then only that expenditure is booked in the P&L, right? Now, what is the logic behind this? Why, as and when the actual expenditure is incurred, is booked? Why not the accrual basis?
Because that expenses is not is accrued. That which means we do not know that when the expenses will happen.
Right. So generally, we do not expect our plant and machinery to break down or requires any repair, right? So suppose if we are living in our house, so we call the electrician only when our AC starts, not performing as expected, or malfunctioning, or we call the expert, every quarter by default. Okay, come and see if AC is okay. So in general life, we also call the electrician as and when we observe anything, right? In terms of the quality we were expecting, right? From the product. So same rule applies to the plant and machinery. If the plant and machinery is performing well, then there is no need to do any repair and maintenance, right? So we wouldn't be any recording any or creating any provision. But as and when we notice something, then we will call the technician. The technician suggests that this is the part which needs to be, corrected, repaired, or some maintenance is required, whatever this maintenance expenditure is required. Then we incur that expense. He submits the bill, we record, and we book the expense. That is the usual practice, right? And if there is any scheduled maintenance which is bound to occur, say every 3 years, every 5 years, or every 2 years, right? So that is also taken care by Ind AS 16. So Ind AS 16 says if there is any expenditure which gives a future benefits for more than one period, right? Then that needs to be accounted for as a separate component within that plant and machinery, and accordingly depreciated, like the example I have taken in my previous session as well for the airplane engine, right? And the ship, right? Docking, right? or overhauling. So same thing here. An airline is required by law to overhaul its aircraft once every 3 years, right? No present obligation that is independent of the entity's future actions. No provision is recognized. Depreciation takes account of the previously capitalized overall cost. So whatever this overall cost is generally capitalized and depreciated over a period of 3 years under Ind AS 16. Correct? And as and when the 3 years have passed, the new overall cost will be incurred and again will be capitalized and again will be depreciated. Right? So,
Yes, sir. We will de-recognize that old asset engine as well.
yes. Correct. So we will not record any provision. Now let's do this question. An entity in the airline industry leases an aircraft. The requirements of the leases are such that lessee is obliged to maintain the airworthiness of the aircraft. Airworthiness requirements for the airline industry are the same whether the entity owns the aircraft or takes the aircraft on the lease. The lease requires the entity to return the aircraft in the same condition as at the inception of the lease when the company has taken the aircraft from the leasing company. When does the entity recognize a liability for this obligation? Which obligation? To maintain the airworthiness at the time of the return. So the liability needs to be recorded on when? When the aircraft is taken on lease or when the aircraft will be refunded on after the lease period is over. What do you think?
Sir, which liability will book on at the time of return the aircraft, sir?
Return aircraft. So
But as per the Ind AS 16, we will put the separate that component accounting. We will do it.
So here you are taking the aircraft on lease. You are not buying. How you are going to apply Ind AS 16 in this case?
Okay, the Ind AS
It will be
116
right. Yeah, it
apply.
will be right of use asset.
Yeah,
Lease.
So in this case, what will happen? The overall and maintenance cost of the asset is a contractual obligation by virtue of the lease agreement, right? Under the lease. In this case, the entity accrues a provision for the overall and maintenance cost, which the entity releases as it incurs and pays the actual expenditure, either several times during the lease or at one time at the end of the lease, right? So, because this is not the case of owned assets, right? It is the case of leased assets. And as per the contract, leasing contract, company needs to maintain the quality of the aircraft same as and when it has received the aircraft at the time of return. So it needs to create a provision. Now, in this case, if I apply Ind AS 37, what is the past event?
Past event is a lease agreement that we are
Past
using that
event
aircraft.
is receipt of aircraft, right?
Yes, sir.
Right? On lease. Correct? So, as and when I receive the aircraft on lease, it means the past event has occurred.
Yes,
Great.
sir.
Now, as per the lease agreement, there is an obligation to maintain the airworthiness quality of the aircraft by spending the reasonable expenditure on that, right? So that is the obligation I carry on the day one. Yes or no? So this is a present obligation as well,
Yes, sir.
right? So because past event is there, present obligation is there, plus probable outflow of cash flow. Yes or no?
Yes, sir.
So probable outflow of cash flow is also there. Reliable estimate. Possible, not possible?
Possible.
Possible, reliable estimate. I will simply ask a vendor who is into the business of maintain what I say, checking the airline quality and telling me whatever the expenditure needs to be incurred to maintain the same airworthiness, right? So that estimate is measurable, all the four conditions satisfied, so provision will be required. Yes, provision will be required, right? So because this is not the case of owned asset, it is a case of leased asset and contractually driven obligation I carry, so I need to record a provision. But in this case, repair and maintenance of my own aircraft was under discussion. Own means owned by the company. That is, India 16 is applied. Yes or no? If India 16 is applied, it means if there is any repair and maintenance which expenditure which needs to be incurred on this airplane throughout the life, then that will be capitalized to the airline cost basis on the tenure at which it will be incurred. Suppose if it is incurred every 2 years, so for every 2 years it will be capitalized and depreciated. If it is incurred every 3 years it will be capitalized and depreciated. And if it is incurred every year, 1 year, then capitalization is not required. Simply the repair maintenance to the P&L. Yes or no?
Yes, sir. In that case, that India 37 will not
Right.
apply.
Right. So in that case, India 16 will not apply if the future economic benefits of this maintenance expenditure is not more than one period, because the criteria for 16, India 16 is not met. Right. So India 16 will go away, and every year, as and when I incur the expenditure, I will record the expenditure. So provision is not required. But in the case of leased asset, provision is required. Is that clear?
Yes, sir.
Okay. Now, restructuring. Although we have already discussed whatever the restructuring requires us to do as per the Ind AS 37, but we will simply touch upon all the restructuring, what restructuring means, what are the examples, what are the requirements. So let's quickly revisit and rewind. So restructuring is a plan of the management to change the scope of business or the manner of conducting the business, right? So this is the restructuring means, right? So restructuring means something is getting restructured, reorganized. The way we used to do, we will not continue with that way. We will change the way we are going to conduct our business in future, right? We are relocating from one location to another. We are discontinuing one product line, starting the new product launches, or some sort of restructuring. Some employees which we think are no more required, we are planning to lay them off. We are hiring some new employees, right? So all these plans or changes which we are proposing to do in the way we are carrying out our business or in the scope of business is called the restructuring, right? What are the examples? For example, sale or termination of a particular line of business, closure of a particular business location. For example, Madras factory closed and Hyderabad factory started, right? Or relocation of factory from one place to another place, change in management structure, right? Fundamental reorganization that have a material effect on the nature and focus of the entity's operations. What is the fundamental reorganization? Some new product launches, some new services launches, right? Which entity was not, doing previously, right? Entering into the new sectors, right? Provision for restructuring cost is recognized only when the general recognition criteria set out for the provisions are met. What are those general recognition criteria? Number one,
Past event.
past event. Number two, present
Present
obligation. Number
Present
three,
obligation.
probable outflow.
Probable outflow.
Number four, reliable estimate.
Yes.
Yes, sir.
Right.
Estimate.
So these are the four conditions. By now, all these four conditions in our blood, right? We will never forget. So if all these four conditions are met, provision is required to be recorded. Now, what is the past event in case of restructuring? Announcement of the plan or actually implementing the plan?
Actually
Announcement of the plan.
implementing.
No, I have repeated it multiple times. Mere announcement of the restructuring plan doesn't mean that provision is triggered, because past event doesn't mean a mere announcement. Past event gets crystallized when some action of that restructuring is initiated, right? By starting communicating to the people who are affected by the restructuring plan, by looking for a buyer for the old factory, and by finding a location for the new factory. So some steps, concrete steps, are taken by the management. For example, advertisement in the newspaper or the media that we are up for sale this particular plant and machinery or factory, right? So this is a concrete step, right? So unless and until some concrete step is actually taken, we will not say that restructuring plan is initiated. So unless and until restructuring plan is initiated, we cannot say past event has occurred. Mere announcement of the restructuring plan doesn't tantamount to a past event. Is that clear?
Okay, sir.
Right? So provision for restructuring cost is recognized only when the general recognition criteria set out for the provisions are met. An obligation to restructure arises only if the entity has a detailed formal plan and raised a valid expectation. So plan is there. Announcement may or may not be there, but they have started some communication, some ground action, so that the people who will be affected or the by the restructuring plan, or the locations which will be restructured, are identified and implementation is started, right, on those affected items, right? So employees are started, being communicated to come on the table and agree upon for a severance plan. Vendors are, communicated that, let's come on the table and discuss how the settlement needs to be completed for the current dues, and how we are going to make the changes in our upcoming transactions, right? So some sort of groundwork is initiated, right? So that means the restructuring plan is initiated, and that is past event condition meeting or getting satisfied. At identifying at least the business or part of the business concerned, the principal locations which will be affected, the location function or the approximate number of employees who will be compensated for termination, the expenditure that will be undertaken for this restructuring plan, and the plan will be completed or implemented, the date, right? So when these items are identified, it means the restructuring plan is initiated, right? And that meets the definition of past event or the condition of past event. No obligation arises for the sale of an operation until there is a binding sale agreement, right? So simply announcing that companies desiring to sell a particular product line or a particular factory doesn't tantamount to restructuring initiation unless and until there is a binding sale agreement has been entered into with any of the prospective buyer, right? When the sale of an operation is envisaged as part of the restructuring, the assets of the operations are reviewed for impairment under Ind AS 36. So first of all, Ind AS 36 will come into play and will be applied to see if there is any impairment loss. If yes, the impairment loss first will be recognized. Then restructuring provision includes only the direct expenditure arising from the restructuring. Like I mentioned in my previous discussion, that any cost which was bound to occur, whether the restructuring plan was there or not, is not the restructuring cost, right? So restructuring provision will only include those additional direct costs which will be incurred by virtue of proceeding with the restructuring plan. If the entity doesn't proceed with the restructuring plan or terminates the restructuring plan, then these additional costs will not be incurred, and hence those costs are the only thing which will be included in the provision for restructuring, right? So these direct costs are demanded by the restructuring, that is, are incurred only because of restructuring, and they are not related or associated with any of the ongoing activities of the entity. For example, if the restructuring plan is proceeded with, then the employees will be laid off and severance pay will be paid. So, what do you think? Severance pay is a restructuring cost, or severance pay is a cost which otherwise will also be incurred?
Sir, which otherwise always also is incurred, sir. It's not from part of the restructuring cost.
Severance pay. So, are you saying, suppose if you are in job, so apart from salary, you are receiving severance pay regularly from the company?
Sir, your voice.
So severance pay company only pays when the employees agreed upon, to be laid off, right? So this is a pay in lieu of their employment. Yes or no? Correct. So this cost is a restructuring cost, because if the restructuring is continued, employees are laid off, then the additional pay will be incurred or additional expenditure will be incurred. So restructuring provision does not include the retraining or relocating of the continuing staff, right? Because the staff which will continue with the company, so if any costs are incurred on those continuing staff, those are not the restructuring cost, right? Marketing of the new location, no, not a restructuring cost. Investment in the new ERP or new, PPND is not the restructuring cost. What is the restructuring cost? Restructuring cost is the cost which is purely direct for the restructuring only, right? Let's do this question. On March 12, 2001, the board of the entity decided to close down a division. Before the end of the reporting period, March 31st, 2001, the decision was not communicated to any of those affected, and no other steps were taken to implement the decision. Now, in this case, because no steps are yet taken for any of this restructuring, right? So, past event doesn't occur. If a past event doesn't occur, there is no present obligation. There is no present obligation. So, there is no provision requirement, right? So, what would be the answer? It is assumed that reliable estimate can be made of any expected outflows, but because there is no present obligation arising out of any past event, right? Because there is no obligating event yet occurred, because there is no steps taken by the company to proceed with the restructuring, and hence no provision is required to be recognized. Correct? Any doubts, questions until now?
Sir, one point you discussed about that retraining cost and relocation cost of the staff and marketing. Before that, you explained, you asked one question. What is that, sir? Said your voice was not clear that time.
So I said only the direct cost, right? Direct cost which is related to restructuring will be covered in the provision for restructuring, right? And standard specifically excludes below cost. Number one, retraining of the continuing staff or relocation of the continuing staff. Marketing expenses the company might need to incur because they are doing a business from new location or a business for new products or services. So they want to advertise, the new products and services offerings. So marketing related expenditure is not the restructuring cost. Or if they are purchasing any new plant and machinery or investing in any new distribution networks or logistic arrangements, that is again not a restructuring cost. So those are the costs which will be incurred for the new business or the business after the restructuring, right? So this is the after cost of the restructuring, not the restructuring cost. What is the restructuring cost? Restructuring cost is the cost which is incurred purely for restructuring. For example, the employees which are laid off, the severance pay to all those employees, the lawyers' fees who carried out the restructuring, right? Other administrative expenses which are incurred for completing the restructuring, right? But once the restructuring is done, new employees are being trained how to operate on the new systems, right? Or new marketing or advertisement expenses for the new product or services the company is now offering. So all those are after restructuring cost, not the restructuring cost. Is that clear?
Okay, sir. Clear, sir. If the any new employee is recruited for that after for restructuring, that cost will be included, right?
No, 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 no. So if the new employees are recruited, those are not recruited for restructuring. Those are recruited for the business which is restructured. Correct? So new employees' salary will continue to flow in as and when they are recruited and paid. Right? So we are not going to create a provision for the salary of the employee which we have recruited for, the future, right? So we don't record those provisions. The only provision which we will record is for the expenditure we incur to complete the restructuring. For example, we have hired a lawyer, right, to draft all the restructuring related agreements, right, with the employees, with the vendors, with the other third parties, right, for all the negotiations to be done, right? So those lawyers fees or the expenditure incurred on the stamp paper of those agreements, or getting them drafted, printed, all those stuff, right? So those expenditure related to the restructuring, right? Is that clear?
Yes, sir. Got it, sir. Thank you.
Okay, let's do this. On March 12, 2001, reporting date, the board of the entity decided to close down a division making a particular product. On March 20, 2001, a detailed plan for closing down the division was agreed by the board. Letters were sent out to the customers warning them to seek an alternative source of supply, and redundancy notice were sent to the staff of the division who were planned to be laid off. It is assumed that a reliable estimate can be made for any of the outflows expected, right? Now, what do you mean? This is a restructuring, yes or no?
Yes.
Yes, sir. This is a right, perfect restructuring, sir.
What is the past event?
First event that board of directors is approved and they send the notice to all the people, affected people.
So, approval of the board of directors, letters to the customers that because we are shifting our business from this location to some other location, so it might be possible we in the future we will not be able to fulfill your demands, right? So please seek alternative sources of supply for your products. Then redundancy notices were sent to the employees who are planned to be laid off under the restructuring. So these are the concrete actions which have been taken, and hence this is a successful restructuring initiation, right? Now, because the past event has occurred, so present obligation is there. Now, because present obligation is there out of past event, and reliable estimate as per the facts can be estimated, and probable outflow is definitely there, so provision will be recorded, right? So the obligating event in this case is the communication of the decision to the customers and the employees, which gives rise to the constructive obligation from that date, because it creates a valid expectation that the division will be closed. Outflow of resources is probable, and provision is recognized as at 31st March basis on the best management estimate. Correct? Okay. Any assets, fixed assets, property, plant and equipment, machinery, furniture, fixture, or others, which are planned to be disposed of as part of the restructuring, will be netted off from the restructuring provision. Yes or no? So gain on the expected disposal of the assets should not be taken into account in measuring a restructuring provision, even if the sale of assets is because of the restructuring that we have already discussed. Here, what will happen? India 16 will come into play, and simply the derecognition provision for any of the property, plant, and equipment will be applied. Yes or no? So restructuring provision will be recorded at gross, right? It will not be netted off for any of the expected gains from the disposal of those assets which are lying there in the factory, which is being closed down because of restructuring, right? So that is a specific requirement of the standard, that we are not going to net off our restructuring provision by these gains. Yes or no?
Yes, sir. This is we have already discussed, I think.
Correct. So what it includes? Restructuring includes only the direct expenditure arising from the restructuring that are both necessarily entailed by the restructuring and not associated with any other ongoing activities, and does not include retraining, relocating of the continuing staff, marketing, or investment in the new system that we have already discussed, right? So restructuring provision will be recorded at gross amount, and it will not be netted off from any of the gains which we expect to realize by selling those fixed assets which are part of the factory which is being closed down under the restructuring plan. X Cements Limited has 3 manufacturing units situated in 3 different states of the India. The board of directors of X Cements, in their meeting held on January 10, 2001, decided to close down its operations in one particular state on account of environmental reasons. A detailed formal plan for shutting down the above unit was also formalized and agreed upon by the board of directors in their board meeting, which specifies the approximate number of employees who will be compensated and expenditure which will be incurred for the closure. Date of implementation of the plan has also been mentioned. Meetings were also held with the customers, suppliers, and the workers to communicate the features of the formal plan to close down the operations in the said state. And the representative of all the interested parties were present in those meetings. Do the actions of the board of directors create a constructive obligation that needs a provision for the restructuring? What do you think?
Yes, sir. It's need that constructive obligation.
Correct, because past event is already incurred. Formal plan is laid out, approved by the board. Communication has happened with the suppliers, customers, and the employees, and planned cost is also computed. Right, so provision will be required because restructuring has been initiated and constructive obligation is present. Correct. So that was it on India's 37 from my side. We will talk about certain disclosures now, and then we will try our hands on certain MCQs from the standard. So what are the disclosures? So disclosures for provisions, right? For provisions, disclose for each of the class carrying amount at the beginning, that is opening provision, right? Then additions made during the year or period, then actual expenditure incurred against those provisions, then reversals if any, and then discounting if we did to any of the provisions, then time value adjustment for the period or the year, that is unwinding, and then closing balance, right? And comparative information is not required. Why? Because we are already giving this walk opening to closing, right? So comparative information is not required for the provisions. Only this walk is required. How the closing provision is arrived, starting from the opening provision or the previous year or the previous reporting date closing balance, right? For each class of provision, we also need to give what is the nature, that is what exactly this provision is made for, a brief description, timing when the provision is expected to result into the outflow of the cash, and what are the uncertainties involved, right? Uncertainties might be dependent on the outcome of the court case, for example, right? So these are the uncertainties. Then expected and recognized reimbursements, if any. For example, in our beauty products care example, we had a contract with the Y Limited contract manufacturer. So in that case, what we will disclose that reimbursements from Y Limited up to the 30% of the claim value, is recognized as a receivable in the balance sheet. If it is impracticable to disclose any of the above information, the fact shall be stated, right? So all the disclosures are mandatory. Because if any of these disclosures management believes will not be able to disclose, then this fact needs to be disclosed that a particular disclosure is not disclosed for so and so reason. For contingent liability, whether the possibility of any outflow is remote, if the answer is yes, no disclosure, where the probability is less than 5%, right? Which we discussed. And if the probability is more than 5%, it means it is a contingent liability. And hence, what we need to disclose, the brief description and the nature of the contingent liability, and estimate how it will impact my P&L and balance sheet, the impact on the financial statements or financial impact, and what are the uncertainties in terms of amount or timing, and what is the possibility of any reimbursement if there is any from the third party, right? So these are the three disclosures required for contingent liability. Then contingent assets. Again, the same thing, whether the inflow of the economic benefit is probable, right? If the answer is yes, then brief description and nature. And if the answer is no, then no disclosure is required, right? And apart from brief nature and description, an estimate of the value of the contingent asset, right? So these are the three items which we have in our balance sheet. Number one is the provision, right? Number two is the contingent liability, and number three is the contingent asset. So specific disclosures are required for all the three items, right? Now coming to the gap differences between Ind AS and IGAP. So first of all, the major difference which we have seen is about which one? Discounting. Under IGAP, discounting was not permitted, but under Ind AS 37, discounting is mandatory for the time where the time value of money is material, right, at the pre-tax rate. But because under IGAP as well, accounting standard is revised to include the decommissioning and restoration and similar other associated liabilities related to the PP&D. So in that case, discounting is also permitted now, right? How many of you are aware that IGAP accounting standards are revised?
No, sir, I'm not aware, sir.
Okay. Do you know when they were revised? Anybody?
In 2016, I believe. 2000.
Correct. So 31st March 2016 was the date when they were revised, right? So it's been 9 years and we are not aware.
But what are the changes is done, I'm not aware. But when it was changed, I am aware about that. I attended that one of that first class, the presentation of the financial statement. That time the faculty told us.
Okay. Okay. No, fine. Okay. Then contingent asset. So under Ind AS 37, contingent assets are not recognized but disclosed. And in IGAP, neither recognized nor disclosed. Correct? Because there was no concept of contingent asset under the IGAP. Impairment loss. Ind AS 37 makes it mandatory to apply Ind AS 37 as and when there is any indicator on account of any restructuring plan. But IGAP is silent on this, right? It doesn't specifically talk about this, but it doesn't mean that we are not going to apply impairment provisions. When I look at the differences between the Ind AS and IFRS, there are no gap differences. Whatever is there in IFRS, the same is there in Ind AS, right? So let's try our hands on quick MCQs now. I will not take more than 2 minutes of your time. I know the time is by my watch 10 o'clock. In accordance with the requirements of the Ind AS 37 provisions, contingent liabilities and contingent assets, where measurement uncertainty exists, which one of the following methods is not an appropriate valuation for the provision based on the accounting standards? A midpoint range of equally likely outcome. Provision should be recognized where measurement uncertainty exists. No provision basically should be recognized. And the minimum amount expected to represent the best estimate, where the other option is omission. And the most likely amount expected to represent the best estimate, where there is a single obligation. What do you think? Anji, what the answer? What happened?
No provision should be recognized when measurement uncertainty exists.
Correct. So the correct answer is no provision should be recognized when measurement uncertainty exists. And that's what I have been talking at the very beginning of the standard. So reliable measurement is a deemed met condition generally, unless and until it is challenged. But because in the facts given in the question, it is challenged that measurement uncertainty exists, and hence, because reliable estimate condition is not meeting anymore among the four conditions, so provision will not be recorded or recognized. Clear? Which one of the following represents an appropriate discount rate for measuring a provision based on Ind AS 37? Market yield on national government bond, market yield on high quality government bond, pre-tax rate that reflects the current market assessment of the time value of money and the risk specific to the liability, or pre-tax rate that reflects the current market assessment of the time value of money and the risk specific to the entity.
C or D, I think.
C or D? C. A specific liability, by virtue of its nature, can carry a specific risk. So those risks needs to be adjusted.
Yes, sir. For the specific liability only, that C is correct. Yeah.
Correct. Which one of the following is a correct statement in relation to the provisions and contingencies? An item of a contingent nature may be recognized but not disclosed in the body of the financial statement. Ind AS 37 applies to provisions to perform a land rehabilitation activity. Ind AS 37 applies to contingent liabilities and contingent assets of insurers that result from insurance contracts, and a present obligation exists in all circumstances where a company may have some choice in whether or not to make a future sacrifice of the economic benefits in settlement of an obligation. Out of the four, which statement is correct?
I feel D, sir.
Why D? What was your logic? A present obligation exists in all circumstances where a company may have some choice in whether or not to make a future sacrifice of economic benefits in settlement of an obligation. So, do you think present obligation always exists? No. Present obligation only arises when past event has occurred. Correct?
Yes, sir.
So D is not correct. Why B is correct? What B is saying? India's 37 provision contingent liability and contingent assets applies to the provisions to perform land rehabilitation activity. Of course, for all the decommissioning liabilities, seabed restoration, land rehabilitation, we need to create a provision, yes or no?
Yes, sir. We created the provision. I
Right?
confused with rehabilitation activity.
Okay, okay. This one. As at the end of the March 2001 reporting date, ABC is involved in a legal dispute with one of its suppliers in relation to the early termination of the exclusive license agreement between the two companies. The supplier seeks a damage of 50 crore. The directors of ABC believe that they will be successful in defending this claim. ABC's lawyers have advised that there is a 90% chance that the entity will not be made liable for this claim. In accordance with India's 37 provisions, contingent liabilities, contingent assets, which one of the following is the most appropriate option for ABC while preparing its financial statements for 31st March 2001? Neither recognition of a provision nor disclosure of a contingent liability is required. Disclose information about the possible liability as a contingent liability. Recognize a provision for the best estimate of the obligation to the supplier. Recognize a contingent liability for the best estimate to the of the obligation to the supplier.
I feel B, sir. Disclose the information about the possible liability of as a contingent liability.
Correct. Because the chances are 10% only that the company will lose the case and required to pay. So 10% chances means not probable because the condition of probability is not met. Probable outflow, right? Probable outflow means more than 50% chances, right? I told or I mentioned. So here 90% chances are it is not likely to happen. So 10% are the chances that it is likely to happen. Hence, no provision is required. Now, because provision is not required, but the chances are more than 5%, so contingent liability disclosure is required. Correct? So that was it. And I thank all of you to, listening me patiently since morning and participating in all the questions. Making the session quite interactive. And I wish you all the very best for your examinations. Prepare well and come as chartered accountants.
Okay, thank you, sir. Sir, what is the contingent asset only, please brush up, sir.
Contingent asset. Contingent asset means any asset that is the future expected probable inflows to the company, but those will not be recognized as per the standard, right? So only disclosure will be required that it is a receivable. For example, insurance claim, right? So if I know that there is an insurance claim which will be received next year for the damages done in the current year. So insurance claim receivable is a contingent asset for the company, right? It is not recorded as an asset until it is received, but a disclosure in the financials will be made that it will be receivable in the future.
Okay, sir. Thank you, sir.
Thank you, sir. Session is over.
Thank you. Thank you.